if you want to have the preservation of capital or premiums, the payout will be lesser. Usually lesser by half.
Half.
Thereabout.
That's a significant amount.
Yeah.
So what do you choose, Eddy? You preserving the capital or maximizing the income for your family?
I choose.
Hi everyone, welcome back to another episode. Today, for our video, we have our CEO, Mr. Eddy Cheong. So Eddy, today we'll be answering some frequently asked questions, and the topic that we'll be focusing on today will be the retirement planning and CPF and also private annuities.
All right.
Okay, let's dive right into the first question that we have.
Right.
So Eddy, a lot of Singaporeans approaching retirement are very worried about not having enough money. So the natural instinct is to invest their money.
Right.
Maybe can you share with me what are your thoughts on this, and is this the right move?
Well, to answer this question, I think it really depends whether you are an investor or not. So if you're not an investor, and because maybe you're not comfortable with the investment volatility risk, then in that case, investment may not be the way to where you retire, right? You don't even have to invest to retire, because done wrongly, it could actually make it worse for you. But the good news is that you don't have to invest in order to retire comfortably, as long as you know how to use your annuities to build your retirement.
I see. So what about someone who is already an investor? What would you recommend, or what's your thought on this?
Right. If you are an investor, then I would think that you are comfortable with volatility risk. But there's one risk that you need to be familiar with as you enter into retirement. That's called sequence or return risk. So what is sequence or return risk? Basically means that if let's say right now as you are working, when the market comes down, you still have your income. You still have salary to actually pay all your living expenses. So you are actually not concerned when there's a market downturn. In fact, market downturn is an opportunity for you to buy low, because you can actually wait for the market to recover. However, when you're in retirement and the market comes down, you don't have income, and you need the investment to actually fund your retirement. So what you do, say the investment were to drop 20%, but you still need to draw down on your investments to fund your expenses. So your investment actually go down even further. So when such market downturn is prolonged, or negative returns happen very early in retirement years, so what it could happen is that it will strain the portfolio from recovering back. So the risk is that with sequence return risk comes poorly for you. There's a risk that the investment may deplete earlier than expected.
So you will not be able to retire on your desired retirement age because of the market, right? Yeah,
because market comes down, if you withdraw at wrong time, the investment may actually deplete earlier, faster than...
I see. So with that, is there a smarter move in a way to, let's say, I still want to retire at the desired age, but at the same time, let's say if the market is down, then what am I supposed to do? All
right. So for those who are investor, who wants to invest to fund your retirement, I think a smarter way will be to isolate your retirement expenses into two categories. One, essential expenses. For essential expenses, that means expenses that you need to spend on a day-to-day basis. Your food, your household, your insurance premiums that you need to pay regardless whether market is do well or not. So for this income, for these expenses, you use annuities, example CPF Life or private annuities, to provide the income for essential expenses. You can still invest above this for discretionary expenses, such as travel, hobbies, or even gifting, where you can be more generous when market is doing well, but you can actually cut back when market is not.
That's a really good combination of having two source of retirement income to fund for two different kind of expenses. So now we are moving on to the next topic, which is about CPF Life. So a lot of Singaporeans swear by CPF Life for retirement. Is it really as good as everyone says?
All right, CPF Life is actually a national annuities. It is backed by the government, so it is very safe. It rides on a relatively high risk-free rate of 4% or above that. And it is able to give a very reliable income, and more importantly, it can pay for life. So CPF Life is actually the best annuities you can get out there at this moment. Okay, but with all the good things about CPF, there's also some risks and limitations of CPF. So there are a few. So firstly is illiquid. Okay, meaning that if whatever you put in to the CPF Life, whatever you top up into your RA account, you cannot take out.
Yeah.
If your life circumstances change, you need to draw money, a lump sum, you couldn't. Whatever you put in the CPF account is illiquid.
Yeah.
And second is not so flexible. As a national scheme, there are certain limitations. For example, you couldn't opt to retire before 65. You couldn't withdraw it before 65.
Okay.
So there are it's a bit rigid.
Yeah.
Thirdly, there is also a possibility of change of policy risk, meaning that the rules around CPF may change. Okay, and if your money is into CPF, there could be stuck in the way when the policies change. And also, if you allocate too much into a CPF Life, it may cause over-concentration risk. I mean, you are limited by the single source.
Okay, so basically what it means is CPF Life is really good, but you cannot solely rely just on CPF Life, correct?
Right. CPF is definitely a very good instrument for you to lay the foundation, but it's not the entire house. You need to build on it to get the reliable income that you need for retirement.
Okay, so Eddy, since CPF Life is so good, then would it make sense for me to just maximize all the way and top up?
Though CPF is a very good annuity plans, it may not be suitable for everybody to actually maximize CPF to the ERS, enhanced retirement sum. That's because for some people, there is this risk called the over-concentration risk, whereby there is a lack of liquidity if you overdo it. So maybe let me give you an example. Let's say for a person who is 55 years old, and he has a total retirement assets of about $500,000, making out of cash, CPF OA, RA, and his other investments, $500,000.
Yeah.
Okay, if you choose to max out to ERS, which is about $440,000. So what it means is that of this $500,000 assets, he will have $440,000 in his CPF RA, leaving behind $60,000 in accessible assets. So this $60,000 may not be enough. If let's say life circumstances change, when he wants to withdraw money, he is stuck because whatever in CPF stays there. He can't liquidate.
Okay.
So for people with limited resources, maximizing CPF to the max may not be the best practical solutions. So at Haven, what we do is that we have a certain rules to help optimize the CPF, to maximize the return, but yet to ensure there's liquidity.
I see.
So first of all, we recommend that you should have FRS. FRS it provides for essential expenses. It's non-negotiable. But after putting the SRS, if you want to increase further, you can top up into your RA. But we have a rule that you should not top up more than 50% of your income producing assets. So in my early example, $500,000, all right? So 50% of this income producing assets is about $250,000.
Yeah.
So this person can actually top up about another $30,000 above his FRS, which is 220 plus 30,000, 250. He can actually top up another 30,000 into his CPF RA, and then his remaining assets will be left with another $250,000. Okay, these $250,000 are liquid assets, are accessible assets. If he wants to increase his retirement income even further, he can use some of this money to buy insurance annuities to increase it. The thing about insurance annuities is that the payout is lesser than CPF, but with one difference. Insurance annuities is able to be surrendered for cash. So if you need to, you can actually surrender this insurance annuity for cash, which the CPF couldn't.
I see. So in this case, you recommend having two streams of income instead of one, solely just relying on CPF Life. Yeah,
because this two stream of income, this two stream of instrument actually provides very strong value proposition. The CPF is government backed, very high payout. As for the insurance annuities, it provides that liquidity should you need to stop the plan.
I see. Okay, so now that we have talked about the FRS, and also the ERS. What about putting only money into the BRS? Okay, because I've heard some people suggest the opposite lah, to put only BRS and then invest the rest to get the highest return. Sounds logical. To you, sounds like you put a little bit and then you invest everything you have. But why wouldn't you do that, or why would you do that?
Okay, so this is very extreme. Just now, earlier question is to max out the
max out,
RA,
either
right?
way,
Now it's
100
to
or
minimize
0.
as much as possible. Because the argument is that, well, CPF only give 4%. Can you do better than that? Can you invest to do better than that? I think in theory, this is not wrong. However, in practice, there are some complication. Is risky and sometimes dangerous. Okay, let me explain how to understand this. The CPF Life right on the 4% interest rates. Okay, so in order to beat this 4%, you need to invest. You need to take risks to invest. When you take risks to invest, there is no certainty. CPF has a guarantee or a certainty. The government doesn't guarantee, but we know that it's very certain. But when you go into investment, it's not certain. In order to beat that 4%, you need to take risk. Typically, you need to take at least a balanced portfolio, comprises of at least 50% into equities, stocks lah. Okay, so in the balanced portfolio, the average return could be ranged for 6% or so. Minus off all the fees that for the investment, it could bring down to about 5%. So 5% is not guaranteed. Okay, market can go up and down. For 5% balanced portfolio, the volatility could be about 10%. Now, what this means is that in the typical year, the portfolio could swing between plus 10 and minus 10. 5 plus minus 10, minus 5% to 15%.
I see.
So what it means is that the investment could lose money. Okay, so a better way to invest, if you want to invest, is to use your cash, which is earn close to nothing, to invest to get a return. Don't use a CPF, because when you use a CPF, you are sacrificing that 4% guarantee for a 5% expected return that without any guarantee will work against you.
I see. Okay, that's a very drastic difference between, like what you mentioned, -5 and 10%. So what if I don't have money to invest? I don't have cash to invest.
This is where it becomes complicated and risky. When a person do not have enough cash, okay, what this means is that this person prioritizes stability of income even more. It means that there is this income stream that he die must have, the essential expenses. You cannot afford to get lower than that because you don't have other cash to back him up. So having this certainty is very important. But when you take your CPF to invest, potentially you can lose money. And I mentioned sequence of return risk. Potentially the investment may run out of money earlier than expected. Whereas CPF Life give a very reliable stream of income and it's for life. So this kind of proposition seems to appeal more to people who don't have a lot of money, but actually it is precisely this group of people should not be using this approach because they don't have this downside protection.
So the conclusion is, if you don't have any spare cash to invest and you want to use your CPF, don't use your CPF to invest.
You're right. Personally, I don't endorse using CPF, BRS plus investment approach to get the potentially higher return. Because this is actually quite risky.
I see. Okay, so we have established that CPF Life is great, but it's not enough on its own. So just now you mentioned about insurance annuity. So how does this come in, and do I really need one on top of CPF Life?
All right, Jayla, that's a very good question. I remember there's a saying, it's something to do about the greatest fear of retiree is not about dying. It's about running out of money. Money not enough. I think that is understandable because for a person who has retired, there's no income source. Okay, there's a need to have an income stream to at least pay all the essential expenses. All right, so you don't have to worry about money. You just enjoy your retirement. So the question then is, what kind of instrument can you use to create this income stream that is safe and reliable? Well, investments won't make it because investments is involved risk that is dependent on market performance, and there's no guarantee. Money can run out, as I mentioned, sequence return risk. So investments, depending on investment alone, is not possible. Then what about your cash and cash equivalents instruments
Yeah.
like fixed deposits, SSBs and T-bills.
Bonds.
These are generally for preservation, asset preservation.
Yeah.
Okay, it's not meant for you to. It's not meant to create an income stream for your retirement. So that leaves us with annuities instrument.
Yeah.
So annuities instrument like CPF Life actually provides an income month by
Monthly,
month,
yeah.
year by
I
year
see.
for as long as you live.
Mm.
So insurance annuities provide that certainty of income over your retirement years so that you can enjoy your retirement more comfortably without being subject to market risk.
I see. So you still have money to pay for all your bills if the market is down, if you're an investor. I see. Since we are on this topic on insurance annuity, right? I have a question. A lot of parents want to leave something behind for their child. Is an insurance annuity better than CPF Life if they want to leave behind a legacy?
This is quite an Asian thinking to leave behind something for their loved ones.
Yeah.
CPF Life is not designed with a legacy in mind. It is designed to provide an income stream for as long as you live. Yes, there is this thing called the bequest, which is a death benefit. All right. So as the death, but this death benefit for CPF Life will actually decrease over time as you receive the income payout. Okay. Well, if you live long enough, the bequest could drop to zero. So when death occurs, there's nothing to leave behind to the beneficiaries. Okay. So CPF Life is not designed for legacy in mind, even though it has a bequest element. If you want to enjoy a stream of income for retirement, but at the same time, in the event of death, to leave the capital or the insurance premiums to next to your beneficiaries, you can actually consider a certain form of life annuities with capital preservation or protection.
Okay.
Okay. So what this means, how the design of this looks like this. Okay. While you are retiring, okay, it pays an income stream, but the moment the person passes away, whatever you put as premiums can be passed on to your estate. So it can be your loved ones or your spouse and so on and so forth. So this is actually okay. The trade-off for such an annuity product is that the payout is actually lesser, but it is able to provide that bequest element to the next generation.
So you mentioned about the preserving the capital, right? And also in this insurance annuity. So if you preserve the capital, this element that it has in this plan, does it mean that it means that when the policyholder passes away, the capital preserved will be passed on to the beneficiary, correct? So during the period where the policyholder is alive, do they get a lower significant amount of guaranteed income because of this element?
Okay, that's a very good question to ask. Okay, so basically, insurance annuity, there are two types. One function like a CPF Life, whereby the bequest will drop to zero over time. The second is where I'll call the bequest or death benefits actually will stay flat throughout. Okay. So this staying flat throughout basically means that in the event of death, the bequest element, which is actually close to what you put in, the premiums, will be paid off to your estate. Okay. If you want to have the preservation of capital or premiums, the payout will be lesser. Usually lesser by half. Thereabout.
That's a significant amount.
Yeah. So it is for people who wants to have this legacy desire, then this kind of instrument might be more suitable for them.
I see. So what do you choose, Eddy? You choose preserving the capital or maximizing the income for your family?
I prioritize maximizing income for myself.
It makes more sense because I feel like if you are like what you mentioned earlier, what I gathered from what you share, insurance annuity, it makes more sense to maximize the income than leaving it for legacy, because like you said, the income would be half, almost half So legacy, I would assume is not for insurance annuity.
I think it really depends on the person's needs. For me, I prioritize having the income first.
I
Okay,
see.
but for some others, there's a genuine need to want to pass the capital to their beneficiaries. So that is where that form of annuities will be more suitable for them.
I see. So it both works like it depends on
It
what
depends
you
on
need.
needs. Yeah.
I see. Okay. So now that I have more understanding on insurance annuity, I still have some questions on CPF Life. I understand that CPF Life has its limitations. So if you could build the perfect insurance annuity to sit along with the CPF Life, what would you advise?
All right. In the whole purpose of leveraging a CPF Life with annuities is to create a stream of income that's highly reliable for your retirement. Okay, so I would think that a good complement to CPF Life will involve a few things. Okay, or a few options. Firstly, it should be able to allow one to enjoy the payout before 65, because that's a limitation of CPF. Payout earlier, start age. It should also provide a higher guaranteed payout per dollar. Okay, per dollar, get a higher payout. Will not be able to match CPF Life, but it's as close as possible.
I see.
Okay. Thirdly, to have the option to have the payout to increase in the future, a step up mode, whether is it on the incremental way or a step up at the later part of the year. This will help to mitigate the effects of inflation. You could also have options to meet various needs. For example, for those who want to have legacy, to have a preservation of capital or the premiums, such that in the event when death occurs, the capital can be paid off to the estate. And also the possibility of surrendering the insurance annuities and then get back the premiums. Okay, so these are various options that will be good for the consumer to know how to complement their CPF.
Okay, so now I have a better understanding what is insurance annuity. I've actually heard of people mistaking ILP as a insurance annuity. So they were sold by the I would say someone with the idea that they are giving a dividend payout. So in this case, how can someone actually tell what is the difference between a ILP and also a annuity plan?
Okay, what you described is not uncommon, but is quite serious because these two are different products serving different needs. Okay, perhaps let me explain the difference. For life annuities, the payout is predictable. There are some guarantees in it, all right, and then the payout could be for life if you buy a life annuities. As for ILPs, the payout is not guaranteed. It really depends on market returns. If the market do well, you can pay more. If not, it can actually lose money. All right. So when you buy ILP, you are subject to market volatility risk. But if you're looking for something that's certain, then you should actually look for an annuity plan.
So how can we then protect ourselves from all this of like buying the wrong plans for wrong purpose?
It is not so straightforward, but I think you can apply certain rules. Okay, so when the presentation given to you, when the advisors show the presentation, you can ask whether the returns are guaranteed or not. Okay, because if it's an annuity or annuity-like program, okay, the returns have some form of guarantee. The payout has one form of guarantee. But if it's an ILP, there's no guarantee involved. It only projected by the returns that they use, the assumptions that they use. All right. So finding out whether is the payout guaranteed is one telltale sign. The other way is to ask for a product illustration, because every product has an illustration and it will spell out exactly what this product is about. Okay. Is it an annuity program? Is it a ILP? Sometimes annuities have different names. Okay, it can be a participative plan, but the key thing is that you want to find out whether is the payout guaranteed. Is there a guaranteed component in it? All right. Well, if let's say after this you're still not clear, okay, I think it's better to walk away. Walk away and not walk away, get second opinion. Because if you buy something that is not what you need, okay, surrendering is actually very expensive.
I see. Because you mentioned check whether if it's guaranteed, right? But you know, sometimes when you are asking a question as a, I'll say as a client or customer asking a question, what if their reply is, this is basically guaranteed? Then
then I would want to see the proof of it.
Okay.
And the proof of it is that every product will always have a description or official description for an insurance company. Just look at it.
I see. So do our diligence and do the research and check on.
That's right.
Understand the plan before we even sign and buy something.
If you're not sure, get second opinion.
I see. Okay, so let's say I want to buy a annuity. How much do I need to pay to get a guaranteed income a month?
Well, it really depends on your needs, your resources, your preference, because everybody is different. Okay, but I can give you a ballpark. If you are early 50s and want to create an income stream for retirement from age 65 onwards, okay, typically, if you put in about 100,000 premiums at 50, you could get about $800 per month total payout. Total payout basically means guaranteed, non-guaranteed. About $800 a month from 65 all the way to 90 or so. It's 25 years payout. Okay. If you want to generate an income of about $1,000 a month at 65, then the annuity premiums could be about 130,000 to 150,000. But that is just, a lot depends on your age, the requirements, and the plan that you are looking at.
I see. So does it mean that if the payout term is shorter and more, then the capital is more or lesser? Because you say 25 years, 65 to 90, right? That is 25 years. 25 years. Then it's 100K. But it also differs if I want a shorter period of payout and more monthly.
Oh, yes. So it is highly customizable. If let's say you don't need 25 years, you just need over 15 years, then the amount that you put in can be lesser.
Okay. So you can you can choose
you can you can customize to.
I see. Okay. So in that case, then for the amount of the payout, how should I know how much do I need?
So first thing that you need to find out is what is your retirement income needs. You establish that in your retirement, how much do you actually need per month to meet your essential expenses. Right. So first, that's the first thing, to find out your expectations. Number two is to look into your CPF, optimize it, and how much can the CPF gives you every month. Okay, versus what you need. And the difference is where the difference between what you need and what the CPF can deliver is called the income gap. So for this income gap, this is where you use insurance annuities to fill this gap. So by doing this way, you will have a stream of income together with your CPF annuities to provide for and meet your essential expenses in retirement.
I see. Okay, so Eddy, this is the last question that I have for you. There is so many financial advisors out there and agent, let's say, offers retirement planning services. So what makes Haven's Retire Sure genuinely different?
Many of the retirement planning approach that I observe are very product driven. So basically, there is a product that is very attractive, and then you buy the product because of its attractiveness. But from our experience, a good product doesn't mean it can be suitable to the person's needs. Okay, because a person's needs could be a different need. Okay, so for Haven, what we do is that we start with needs-based approach first to understand what you really need, and then we do the recommendations. So typically, when a lead comes in or when an inquiry comes in, we will first find out what is their expectations, what is their retirement expectations, what is their financials, their income, expenses, and what is the retirement goal that they want to achieve. Okay, the retirement income stream that they need for their planning. And then we look into optimizing their CPF, because optimizing CPF will help to create that income. But
Okay.
again, CPF also have its limitations. And therefore, we need to optimize properly to balance between liquidity as well as return. Then we look into the 3 C's of retirement, which is cash flow management, coverage management to make sure that you have sufficient medical safety net, as well as creating and developing a certainty of income for you to meet your goals. We explore all options to help you create the income stream that you need for your essential expenses without the need to take investment risk. What I described so far is what we do, but perhaps more importantly is what we set up Haven to be. Haven is set up to be a safe place for people to seek insurance and retirement advice without the fear of being missold due to conflict of interest. Therefore, when we set up Haven, we put in control factors to mitigate this sales conflict and offer a money-back guarantee so that when people come to Haven for advice, they can be assured that this is what they need.
I see. Thank you so much for sharing with me all this, Eddy. If the episode today have made you start thinking about your retirement planning, don't afraid to reach out. You can find us at haven.com to understand more about our Retire Sure and book an appointment with one of our insurance specialists. Okay, thank you so much, Eddy. Thank you for joining us today on this episode. We will see you on the next one. Please remember to like, share, and subscribe, and leave a comment down below if you have any questions. Bye-bye.
Bye-bye.